Just briefly as an introduction, this is the Sunday, February 5th, 2023 new week opening gap. And the way you want to locate that is you want to go into a lower time frame chart. You don't want to use your daily chart because your daily chart is going to be using a settlement price that may not be in alignment with what we're showing you here to use. So you can use a 1 or 5 minute chart. And you're going to be using the Sunday's opening price, which will be represented here on the 5th of February, and the closing price on the Friday prior. Okay, so there's a difference between those two price points here. Okay, so it's the open on Sunday and the close on the previous week's Friday. Then you get a measurement, midpoint here, which is consequent encroachment. So that's basically what it looks like on my chart. And we'll take a look at some more examples of it now. But this is essentially 5 weeks ago, based on today's actual date of this recording. The week after that, next Sunday, would be Sunday, February 12th, 2023, and this is the new week opening gap for it. And here's the closing price on that Friday. Then the opening price on Sunday. And the midpoint here, which is consequent encroachment, the difference between the two. Now, the ICT New Week Opening Gap is a tool that I utilize to give me large fund fair value, meaning that the markets will generally gyrate on a little bit higher time frame, pulling back to old new week opening gaps, whereas everyone knows that there's gaps. Okay, I didn't invent a gap on Sunday, but the approach to utilizing it and how the algorithms refer back to it as a point of fair value, it's kind of like when an inefficiency is filled in and repriced to. Most traders that are familiar with it, they're trained to think that, okay, it's over with, now let's move on to the next thing. That's not how the algorithms work. The algorithms refer to old inefficiencies and old liquidity voids. Now, a real liquidity void is an absence of any buying and selling. There's no printed data between two specific price points. In this case, we're focusing on the previous week's Friday close and the opening, Sunday's opening price. So if there's a difference between those two price points, that gap is a real liquidity void. That's a real liquidity void. There's no trading there. So when the market moves away from that gap after repricing into it, it can refer back to it weeks ago, a month ago, or more. So what I have learned is by having them on my chart, and I like to have a minimum of 5 weeks worth of it. And at the time of this recording here, today's date is March 8th, 2023. Now, I introduced the concept on Twitter in February 2023, but I actually taught my private students about this specific thing here, but I'm bringing in more elements to it because, we're mentoring publicly now, so there it is. But you want to have at least minimum four new week opening gaps on your chart for proper perspective of large fund fair valuation. I like to have 5 because it keeps a kind of like a dynamic full month's perspective. So that way it kind of gives you a little bit of an overlap, not just the blanket 4 weeks look back. So using this chart here, let's take a closer look here at what we've seen for this week. Looking back 4 weeks ago, the date would be February 19th, 2023. And this is a 1 minute chart. So referring to Friday's closing price here, and then Sunday's opening price down here. So my candles, when they're green, they're bullish. That means it's an up close candle. A black candle is a down close candle. So we're using the closing price on Friday, the opening price on Sunday. So those two price points there's a difference. Even though we see it trade back up to it here, from the open, trade right back up to it, That's normal. You expect to see that. But once it does that, we don't ignore this gap. Like most other individuals in technical analysis, they're familiar with gaps. Gaps tend to be filled. But once they're filled, they're generally discarded. Not me. I hold on to these things because the algorithm that's delivering price will refer back to these price points, as you'll see here. So now with those two levels annotated, I like to use a ray. Okay, so it's kind of like a short trend line that anchors to one specific price point and just projects to the right. This is annotating Friday close price at 4:59 p.m. Eastern Standard Time. That's the East Coast time of the US. The opening price here on Sunday at 6 p.m. Eastern Standard Time. So there's our two reference points, and that is the basic new week opening gap. We're going to take it one step further. And you're going to take your Fibonacci and you're going to anchor it to Friday's closing price. And if the Sunday opening price is lower, you're going to drag the Fibonacci down to it, anchor it there, and then your 50% level, you're going to note that. That's going to be consequent encroachment. Because this is an inefficiency or gap, the midpoint of that is consequent encroachment. If it were an order block, it would be mean threshold. So this is what a dressed new week opening gap would look like. The high, the low, and consequent encroachment in the middle. Now, incidentally, I'm looking at this and I thought about how you could, if you want to annotate yours and keep record of what they're referring to, where this is being typed in, this can be the actual Sunday date. So in other words, you can label this on the Sunday's date, so that way you know which one of the new week opening gaps this is as you go in the future, because we're going to have multiple on your chart. And if you don't have them annotated, it may be a little bit of a hassle to figure out where they're at. I don't have a problem with that because I write everything down on a notepad. So on my desk, I had very specific levels and what they're anchored to by date. But if you want to be highly organized on your charts, you can set this up as part of your annotation, just where the text point of a trend line or whatever you're annotating, just set it up for middle and maybe right justification. So that way it would always show on the far right end of the chart. Whenever you're looking at it, it would show you the anchor points referencing the date. Or you can do it this way too. You can do the Friday date here with that and then use the Sunday date for that. But I don't like that because you may be zoomed in and you might see this level here and it might disorient you because you would expect maybe a higher level here for consequent encroachment and then the opposing level of the new week opening gap. So it's just a matter of personal preference. I don't really annotate. I'm just showing you here as a suggestion. So fully dressed and labeled here is the Sunday's February 19th, 2023 new week opening gap. Okay, and then we have the following week would be Sunday, February 26th, 2023 new week opening gap. Friday's closing price here. Sunday's opening price here. Between the two, 50% consequent encroachment. And incidentally, you can add quadrants. So if you have the low of the new week opening gap, the high of the new week opening gap, you have the 50% based on the fib, midpoint, consequent encroachment. And then you can get the midpoint between the high and the 50% level to give you the upper third. You do the same thing down here between the 50% and low, the lower quadrant. So I like to use new week opening gaps that are split into quarters, but I don't need to have the lines there. So whenever I see the midpoint and the high, I can roughly see the midpoint here without having a line on it, because I like to keep my charts clean. But if you'd like to have that line on here and the one down here, you can simply add that as well. And then bring us up to date with Sunday, March 5th, 2023 new week opening gap. Friday's closing price here, Sunday's opening price here, consequent encroachment between these two midpoints here, and there we can see the complete new week opening gap for March 5th, 2023. Now, once you have this and you lay it across your chart, you can see how price refers back to those old new week opening gaps, and they many times are treated as support and resistance. By having at least 4, preferably 5, it gives you a rolling 30 days or month look back. Now, there's no real limit as to how many you want to keep on your chart, but I think this is an optimal level here, so we can see what's being referred to and how the market can gyrate back to real fund level valuation for fair value. So it's not just simply a matter of a fair value gap, but we use the new week opening gaps like fair value. And you can see how we gyrate from one level to the next. This vertical line here delineates the gap for that particular week. You can see how we've acted as resistance here, consolidated around until here, found some support, trade through it. And then the new week here, because this one here is that new week opening gap for this particular week going from this date to the right. Look at how price is respecting consequent encroachment of that new week opening gap. And again here, the high and consequent encroachment rejects it, then trades back down into the new week opening gap of this particular week. It leaves it. We start a new week opening gap here, and look what happens. The market moves away aggressively. So we have a trending day, trending week, where we move away from the new week opening gap. So when we're close to the new week opening gap, we're in range bound. If it has a difficulty moving away, keeps coming back to it, we're in consolidation. Range expansion or trending is when we leave the new week opening gap and don't return back to it. You can see we have nice weekly trend model there. The new week here, you see how he traded into it here, support, whipped around resistance, moved lower, came back up, support, rallied. New week opening gap here, and we gravitate back to an old new week opening gap here. And then finally back down into a previous week's new week opening gap as support.